The Federal Reserve cuts a key interest rate by a quarter point and signals two more cuts by the end of the year. Fed Chairman Jerome Powell announced the cuts, the first since December of last year. Lower interest rates could reduce borrowing costs for mortgages, car loans, and business loans, in turn boosting growth and hiring. Wall Street responded well to the news. The Dow ended up more than 250 points. Joining us to discuss further is Todd Stankiewicz, co-portfolio manager of the free Markets ETF. Thanks for joining us.
Thank you for having me.
So the Fed just lowered its benchmark rate by a quarter point and signaled two more cuts this year. What message do you think this sends about the central bank's outlook on the economy, especially the weakening labor market?
Yeah, I think that this came as expected. Everyone was expecting pretty much a 25 basis point rate cut today and two more for the balance of the year, and the Fed gave them exactly what they were looking for. One of the things that was a little different was the more hawkish tone for next year, where a lot of people were factoring in another three rate cuts next year, and they're now just talking about one rate cut next year. So I think there's two messages going on. First off, that they're providing insurance cuts, which is what Powell basically directly said today. And they are saying, though, that the economy may not be as weak, or they don't have to go and have this the beginning of a larger rate cutting cycle, is really what the message that we're seeing from Powell. I just don't know if it's going to lower all the borrowing costs the way people expect it to, because back in September of 2024, when they cut, Treasury yields actually went higher. And when you look at mortgage rates, they're benchmarked off of Treasury yields. But when we look at things like HELOCs and home equity lines of credit, which are based off of prime rate, those may come down as we see the federal funds rate cut.
So as you just outlined, trying to do the balancing act, when might we reach that sweet spot of stimulating growth while containing inflation? And what would it look like for everyday Americans, especially workers and small business owners?
Yeah, I think this is a big part of the challenge right now, because a lot of people are concerned with the Fed cutting rates as inflation started to creep up a little bit. And they talked about that today, that inflation is still running higher than the levels that they want. Is that there's a lot of concern that this may stimulate demand, or if we have lower rates, may stimulate the economy a little bit to run hot. So what we believe is that we may see a deregulatory initiative, or we already are seeing it, right, through executive orders and legislation. If we ease regulation within the industry, we could actually spur supply, and this could offset some of this, let's call it, higher demand that could be spurred from lower rates. So ultimately, that's what we're thinking could offset some of this, and could mean that we hit this sweet spot of growth overall, and this could allow this economy to continue to run.
Quickly looking ahead, with two more rate cuts anticipated this year, what key economic indicators should Americans watch to gauge whether the Fed's approach is succeeding, or if risks like higher inflation resurface?
Yeah, the two primary things you have to watch are employment, right? We got to think about the Fed mandates: employment and inflation. So we want to watch CPI, core CPI, PCE, and we also want to watch what happens with the employment numbers. One of my favorite data points to watch is not just jobs numbers, but actually what the 4-week moving average of initial unemployment claims are. As long as that stays low, I think we have a healthy economy, because that means that people aren't being laid off. And as long as inflation stays around this 2.93% number and doesn't start to spike, I think that that could be a good sign that the Fed continues on the path that it's in, and we have a sustainable economic environment.
Todd Stankiewicz, thanks so much for your insights.
Thank you very much.